Hello and welcome to Livewire's 2024 Alternative Series. I'm Ali Selby, and today we're very lucky to be joined by Kelli Marti from Churchill Asset Management by Nuveen for our insights into the private capital market. Thanks so much for joining us today, Kelli. It's really lovely to speak with you again.
Pleasure to be here, Ali.
Let's start with the basics. What is private capital?
Broadly speaking, private capital is a transaction between a non-bank lender providing a loan to either a company or a specific asset. So the biggest difference between private credit and public credit is that private credit is not liquid. They're not publicly traded. There's not a bid-ask, if you will, on a daily basis for these assets. So they're typically going to be buy and hold assets from the lender providing the original loan.
Does private capital have a cycle like public equities do? And if so, where are we in that cycle?
Yeah, so we definitely don't view private credit as having a cycle, as being cyclical, if you will. So one of the main attributes of private credit is that the asset class tends to have very low volatility. So while you see a volatile nature to public equities and public loans based on headlines, based on supply-demand imbalance or technicals, the private credit space has much lower volatility, and that's one of the primary attributes of the asset class that's really attracting investors today. So if we look at the types of trends in private credit, if you will, the ability to provide income potential, risk-reward potential within a portfolio, low volatility, low correlation to public assets, and those attributes don't really change based on macroeconomic cycles. It's a very resilient asset class. So again, I wouldn't characterize it as having a cycle or that we're currently in a cycle. We view private credit in general as a long-term tactical portfolio allocation.
We've just held our annual investor event. It's called Livewire Live. And on the stage we had two wealth advisors, financial advisors, talked about how they're allocating more and more to private capital, to private assets in client portfolios. Do you see that continuing?
We absolutely do. And one of the main reasons is just the increase in education about the asset class. So as wealth managers and RIAs and really the retail wealth community in general is learning more about the asset class, learning more about the very favorable attributes that the asset class provides, we're seeing that type of investment pace continue. So again, it's going to take education because in the private credit space, not only are the assets themselves quite different, asset class to asset class, but the manager's approach to the market is very different. So again, when we're talking to investors in the retail channel, we spend a lot of time on education, discussing our firm, how we differ from other firms, how our approach to investing differs from other funds in the space. So again, it's that education, spending time in the retail channel that's really helping boost the investment pace and volume in the retail channel.
Let's get into some of that education now. What do you think are some of the common misconceptions around private capital?
There are a couple of misconceptions that I'd like to debunk today if I could. First of all, the asset class itself. When you think about private capital or private credit, there's a misconception that it has to do with only real estate, that it's only real estate assets or real estate loans involved in private credit. And in fact, that is one aspect, that is one asset class within private credit, but it's a much broader universe. Private credit in general can include venture capital, distressed or special situations. Of course, it does include real estate, but at Churchill, when we look at private capital and private credit, we're focused on providing debt to middle market U.S. borrowers. And that composition of that debt could include senior secured floating rate investments, or it could include second lien loans or junior capital investments. And even we also provide equity co-investments. So the asset class is much wider than perceived in the market. And the nuances within the specific subcategories of the asset class are nuanced as well. Another thing I would like to debunk is when people think private credit versus public credit, there's an illiquid nature to private credit. And some investors think that creates more risk in the portfolio, that somehow these are more risky assets. Perhaps they're smaller companies, and that by itself introduces more risk. But as we'll dive deeper in today as we discuss the asset class, the due diligence involved in selecting these portfolio companies within private credit is very deep and long-term. We're spending weeks analyzing these borrowers, assessing these investment opportunities. While the borrowers are typically smaller from an earnings perspective than those in the public markets, we don't view these assets as having more risk because we're choosing very select assets to include in our portfolio. Our selectivity is about 5% of the asset opportunities that we see. So again, smaller borrowers, but they're hand selected to be what we view to be the most positive performers in the asset class.
Kind of debunked a few of the risks there, but are there any risks that you think investors should be aware of when they're investing in private capital, private credit?
Well, investments in themselves are inherently have some element of risk, of course. So it's really a matter of where is the manager investing in the capital structure. So if you're talking to a firm like Churchill and we're investing primarily in the senior secured floating rate part of the capital structure, top of the capital structure, first in line of repayment, and these loans are secured by the assets of the business, and they're also supported by the private equity sponsor and their investment in the underlying portfolio company as well. So important to understand, one, where the asset manager is sourcing their assets, two, how are they capitalizing the underlying borrowers, and three, where do they sit in the capital structure vis-a-vis the other lenders in the participation. So those are things to consider as you're looking at the asset class and trying to understand how one asset manager differs from another.
There's been two very big topics that have taken over the world in 2024, one being the US election and the other being the outlook for interest rates. Given that you're there in the US, what's your outlook for interest rates in 2025? And do you feel like you're siding with consensus in terms of interest rates heading southwards, or do you believe the market is getting it wrong?
Oh, sure, it's a great question and certainly top of mind. You're right about that. So we just had a 50 basis point rate decrease. So we are seeing that flow through into the underlying base rates of the assets that we're underwriting. And the expectation into 2025 is those rate cuts will continue. Now, it's hard to say with absolute certainty the number of rate cuts and what the magnitude of those rate cuts will be, but the expectation is we're certainly going to see future rate cuts in the next 12 to 15 months. And I don't think that's inaccurate. We've had SOFR, or our base rate under underlying assets, sit at about 530 basis points for many quarters now. We're now starting to see that come below 500 basis points currently. And again, the expectation is we're going to see further declines into 2025. And I think that the speculation of that occurring, again, speculation, but it tends to have a more accurate lens as we look at the overall economic landscape and the fact that the Fed really seems to agree that having some sort of rate cut continuing into 2025 will be positive for the economy.
Spreads have tightened in recent months as the macroeconomic environment continues to improve. What does that mean for deal flow and competition for investments, and how does that impact your thinking?
Absolutely. It's actually a welcome relief. And if we look at what's happened in the M&A market over the last 12 to 18 months, the higher for longer interest rate environment has definitely impacted M&A activity. As sponsors are looking to finance these leverage buyouts, a higher cost of capital can be a deterrent for private equity sponsors to want to transact. So a lower interest rate environment is actually a very strong positive momentum for M&A activity. We expect M&A activity to increase as a result of the new rate environment that we're experiencing. And the other thing to consider is, from a borrower's perspective, a lower cost of capital is favorable from a cash flow perspective as well. So again, lower interest rates are going to be hopefully a welcome rebound to M&A activity, as well as a positive change from the borrower's perspective.
Okay, let's get into how you invest. What are some of the characteristics you look out for in both the businesses that you finance and also the private equity firms that you partner with?
Yeah, absolutely. Happy to discuss that. So from a credit perspective, we look for certain credit attributes at the underlying borrowers that we finance. And first, I'll start with the management team. So we're looking at these borrowers, we're spending weeks getting to know the management team, getting to understand how the company is competitively positioned, what their market share is, are they a market leader, et cetera. So some of the primary attributes we like to see are market leadership, very strong financial history, so a fact pattern that as you're underwriting the business, you can get comfortable with as far as their historical earnings. What their competitive advantage is, what makes them different in the market. What's the private equity sponsor's thesis? What do they see as the ability to improve the operational performance of the business? Is the business subject to cyclicality? That's a very difficult concept to get comfortable with as you're underwriting a business, and to underwrite future and projected cash flows of a business that shows cyclicality is difficult. So we tend to look for companies that have a non-cyclical aspect to their demand patterns. And again, to your point, what do we look for in a private equity sponsor? So the private equity community that we spend so much time cultivating relationships with, we have long-term relationships with hundreds of private equity firms here in the US. It's built on a foundation of trust and relationship. So as we get to know these equity sponsors, we spend time with them, we invest in some of their companies, we know what their track record looks like. We know how they act post-close after the LBO is completed and whether they continue to support their portfolio companies. So those are all very important aspects that we look for as we look into aligning with certain private equity sponsors here in the US.
Is it possible you could take us through an example just to bring that all to life?
So again, starting from the beginning, a private equity sponsor looking for an attractive business to purchase. So one company that we recently financed is a company that makes dental equipment. So as you go for your routine checkups at the dentist, this company provides that entire packet of instruments, if you will, that are used in just a normal dental cleaning. So recurring revenue, because these are consumable products, non-cyclical, because certainly dental visits are not subject to cyclicality, and importantly, a management team that was very strong operationally as we looked at the business, coupled with a private equity sponsor that we had a long-term track record with, a relationship with that we knew and trusted. So as we began to underwrite this company, we saw a lot of positive credit attributes, and alongside that, the structure of the transaction was appropriate. We were providing an element of debt to finance the leverage buyout, and the sponsor was providing even a higher element of equity to support the buyout. So we had that proper alignment between the debt and the equity composition of the capital structure. We saw very strong historical financial performance, coupled with the ability of very strong free cash flow opportunities in the future that help support the debt financing structure that we were proposing. So all told, we saw a business with very strong credit attributes, but also coupled with a private equity firm that we know that we had a relationship with, as well as a structure that was appropriate for the deal. So that's a recent example of a deal that we just closed.
Yeah, well, I just went to the dentist last week and can completely agree. Those businesses are a license to print money. It was so expensive. Let's move on now to our next question. We talked before about the Fed's rate cut outlook. How would an environment of declining rates impact returns? In your view, what's the return and income outlook for private credit investments?
Sure, absolutely. So when we look at the yields on the underlying assets in private credit, the yields are comprised of really three elements. So the base rate, in our case SOFR, which has been stubbornly high for many quarters now. We're starting to see that to decline. We have the base rate plus the spread on the underlying asset, as well as a slight discount when we're purchasing the loan. So those three elements can vary based on market conditions, but the main driver of a decline in yield in the current environment will be that decline in SOFR, or the base rate. So when we look at the asset class historically, the long-term yields generated by the senior secured debt asset class have ranged between 6 and 7.5%. So currently, given the market dynamics and where SOFR is today, these assets are earning about 10.5%. So still a very significant premium to the long-term average yields experienced by the asset class. So again, as SOFR declines, we will start to see that 10.5% yield environment start to decline as well, but still very attractive investment horizon for sure.
How would investors allocate to private capital, private credit in their portfolios? Where does it sit? What percentage would they normally allocate their portfolios to this asset class?
Private credit is included in what we call the alternatives bucket within a portfolio. And alternatives are typically included in the fixed income portion of a portfolio. So whether an investor subscribes to a 60-40 rule or some other portfolio allocation strategy, that private credit portion within the alternatives bucket can range, certainly based on investor appetite. We've seen some investors seek up to a 10% allocation in alternatives, some seeking a lower percentage, but it's certainly an important part of an investor's portfolio.
Okay, well, thank you so much for your time today, Kelli. It was awesome to feature you once again on Livewire's content. If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.